Exchange-traded funds, or ETFs, are financial instruments that follow an underlying index or collection of assets, such as securities, bonds, or commodities. They are a well-liked option for investors to access a broad range of investments and cheaper trading costs. However, there are many different types of ETFs available in the market, and for some people starting out, ETF picking gets quite confusing. Welcome to Lexo Life, your partner toward personal growth and success. This is the second video in our ETF series, and we're just as excited as the first one. If you haven't watched the previous video, you can also check that out on our channel or the link below. Now let's get started. Exchange-traded funds, or ETFs, is a form of investment that holds a basket of assets such as stocks, commodities, or currencies and trades on stock exchanges like individual stocks. While it shares a few traits with both stocks and mutual funds, ETFs are an interesting and valuable asset in itself. But why invest in ETFs? ETFs are a fantastic means to diversify your investment holdings. ETFs store assets in a single fund, such as stocks, bonds, or commodities. ETFs provide investors exposure to several sectors and businesses. They are readily available in many industries, including technology, healthcare, energy, and real estate, enabling investors to profit from specific market trends or themes. By diversifying your investment across several businesses or assets using an ETF, you lower your chances of suffering losses if one specific company or asset underperforms. Let's discuss some additional criteria to consider when choosing an exchange-traded fund. The first is if Vanguard is the company producing the fund. Purchasing ETFs from the wrong provider can significantly affect the performance of your investment. For this reason, you want to ensure that the ETF provider whose ETF you're investing has the technology and stability to keep costs down and manage risk. Selecting an ETF. You must choose an ETF once your investment objectives have been established. Several ETFs are available, each with a unique investment philosophy and purpose. You may learn more about ETFs by reading their prospectus, which details their investing goals, risks, and costs. You may also use internet sites like Investopedia or Yahoo Finance to better understand ETFs and evaluate their performance. These are three well-known ETFs that have historically done well, but keep in mind that previous success does not ensure future success. The SPDR S&P 500 ETF replicates the performance of the S&P 500, an index of 500 large-cap U.S. equities weighted by market capitalization. This ETF has consistently grown and has traditionally given investors broad exposure to the U.S. equity market. iShares MSCI EAFE ETF, an exchange-traded fund, monitors the performance of developed market equities from regions other than North America, such as Europe, Asia, and Australia. Investors seeking global diversity in their portfolios use this ETF. The Nasdaq 100 Index of 100 of the biggest non-financial businesses listed on the Nasdaq stock market is tracked by the Invesco QQQ ETF. Investors seeking exposure to significant technology and growth-oriented firms always use this ETF. Popular types of ETFs for your portfolio. Equity ETFs. Several investors pool their resources in an equity fund to purchase stocks in various businesses. Without buying individual stocks, each person may own a portion of numerous multiple companies in this way. Either professionally managed equity funds or funds set up to automatically track an index like the S&P 500 can choose which equities to purchase and sell. Equity funds come in a wide variety, allowing investors to select one that fits their investment objectives and risk tolerance. Fixed income ETFs. With a fixed income ETF, numerous investors combine their funds to purchase fixed income instruments like bonds or preferred stocks. These securities give investors a predetermined sum of interest or dividends until the maturity date. Investors are then given their initial investment amount back. Fixed income ETFs are intended to provide investors consistent income while protecting their money. Diversification might be one of the benefits of investing in a fixed income ETF. You can invest in a fixed income ETF that owns various bonds rather than just one or two single bonds. This can lower the total risk of your investments. Commodity ETFs. ETFs that invest in commodities or raw resources like metals, wheat, and oil are known as commodity funds. They can invest in a single entity or various things via futures contracts. Investors may profit from them in terms of diversification and inflation hedging. UNG, UGA, and DBE are some instances of commodity funds ETFs. Real estate ETFs. ETFs that invest in securities in the real estate industry are known as the real estate ETFs. These funds frequently concentrate solely on real estate investment trusts, or REITs, property portfolios that have been securitized. REITs give investors the liquidity of traditional equities and the possibility for income. Investors can obtain dividend payments by purchasing REITs. One benefit of investing in a real estate ETF is that, as compared to other choices, it offers a less expensive way to do so. Real estate ETFs can also offer diversity by owning various assets related to the real estate industry. Your investment in an ETF may be affected by the ongoing changes in the financial markets. You can keep up with market movements and modify your plan by monitoring your investments. ETFs might have tax repercussions such as capital gains and losses. You may reduce your tax obligation by selling your investment at the right time by keeping a watch on it. As you've just learned, ETFs are a terrific method to diversify your portfolio and perhaps increase your profits. Some people think it's safe and steady, others believe it's slow and low profit. So it's definitely up to you how would you want to incorporate ETFs into your portfolio or not. No matter your personal preferences and choices, Luxo Life is here for you. Remember, investing entails risks, and there is no guarantee of returns. ETFs can help make your portfolio risk more manageable and also offer a wide array of diversification that would allow you to have a hand in an entire market sector with just one ETF. So what are your thoughts on these different ETFs? Is the sky clearing up enough for you? Let us know what you think in the comments below. If you like this video, please leave us a thumbs up and subscribe to the channel if you haven't yet. Don't forget to click on the notification bell so you'll always stay updated with our future videos and posts.